1-42, we're going to prepare the income statement, the statement of owner's equity, and the balance sheet. So presented here are the accounts of Golden City Barbershop for the year ended December 31st. So we click on here, and in a random order, we have all of our accounts. Requirements: we're going to prepare an income statement, statement of owner's equity, and then the balance sheet. So in order to do this problem, you have to understand the three financial statements and their formulas. So we first do the income statement, and the formula is simply revenues minus expenses equals net income, also called net profit. And if expenses are greater than revenues, it would be a net loss. So let's work on the income statement. Notice we only need our revenues and we only need our expenses. So revenues will always have the word revenue in it, and expenses will always have the word expenses in the name of the account. So we always start off our financial statements with a three-line heading, and the three-line heading is always the name of the company, so Golden City Barbershop, the name of whatever the statement is that you're working on. We're working on the income statement, as it says right here. And then the third line is always date related. So when we're doing an income statement, do we want to know the net income over a period of time or on a single day? We want to know the net income over a period of time. And in this case, it says for the year ended December 31st. So this will be year ended December 31st, 2016, which means we're going to show the revenue for the whole year, and we're going to show all the expenses for the whole year, and we're going to subtract the two and then show the net income for the year. So we're going to start with revenue. So this is just a label, and then down here we're going to list all the revenues. So looking through here, I see one revenue, service revenue, $195,000. So I like to double click, copy and paste, but you don't have to. You can sit here and type in the number, 195,000. Now notice I did not put the comma in there. You can put the comma in there. I did not put the comma in there because it's one more keystroke, which gives me a greater chance for error. A lot of students accidentally hit a decimal instead of the comma, and then that would be wrong. So this is service revenue. Okay, looking through here, I don't see any other revenues. So now, going back to our formula, remember the formula is revenues minus expenses. So we're going to list the expenses. Now, my accounting lab does not care what order you put the expenses in. So I'm just going to go in order. So starting here with land, I'm going to work my way down and find the first expense. So remember, expenses in this class will always have the word expense in it. So property tax expense of $2,700. And after property tax expense, we have rent expense for $11,000. Copy and paste, or just type it in there. Rent expense. And after rent expense, we have salaries expense, $61,000. Now, in the real world, most companies will list the larger expenses first, and then so the expenses will be listed from smallest to largest. Largest to smallest. And like I said, my accounting lab does not care what order you list the expenses as long as you have them on the correct line. In other words, the $2,700 right here needs to be on the property tax expense line. So what else we got? We got advertising expense, so $13,000. And then after advertising expense, we have insurance expense, $2,500. And then we've got interest expense, $7,000. Okay, now what we're going to do is we're going to add up our expenses. So that gives us our total, our total expenses. So remember, you have the calculator here if you want to do it this way, or you can use a handheld calculator, or if you like using those desktop calculators, you can do that. 2,700 plus 11,000 plus 61,000 plus 13,000 plus 2,500 plus 7,000 equals $97,200 of expenses. So I can type that number here, or since I'm using this calculator, I can just press this arrow key and it shoots it over there. I don't have to worry about mistyping it. Now, I can optionally put a minus sign here if I want. I'm not going to, but remember, you can if you want. But you do need to know that we're taking revenues and we're going to subtract the expenses. So I need to take $195,000, which is revenue. Let me clear this. 195,000 subtract 97,200 gives me a net income of 97,800. So I'm going to click here, hit the arrow, and it shoots it over there for us. So this company does have a profit. All right, now we're going to work on the statement of owner's equity. Notice the rule in green here. It says use a minus sign or the parentheses to show a decrease in capital. So before we can work on this problem, we need to know the formula for the problem. So it's bind with an E. Beginning capital, meaning the capital at the beginning of the period. We're going to add investments, and remember, investments are also known as owner contributions. That's important. The book usually calls it owner contributions. We're going to add net income, which came from the income statement. We're going to subtract our draws, also known as withdrawals. And then the result is the capital at the end of the period. So let's do our three-line heading again. Name of the company, name of the statement, and then either a single day or a time period. So remember, the statement of owner's equity is showing what happens to capital over the period. So we have beginning capital. That means the capital at the beginning of the period. What happened to capital during the year? Remember, capital is affected by investments, draws, and then revenues and expenses, which show up over here as net income. And that gives us our ending capital. So the statement of owner's equity shows what happens to capital or equity, same thing, over a period of time. So we're going to use year ended. So we want to show our readers of this statement what happened to our equity or capital over the time of 1 year. So let's go back, look at our accounts by clicking on this button here. Now notice, going back to our cheat sheet, we're going to start with beginning capital. So this means capital at the beginning of the period. So what is this period? If we look over here, the period is the year of 2016. So let's look over here in our box. Do we have any capital at the beginning of 2016? The only capital I see is right here. Now some of you say, well, this is for 2015, but look at the date closely. It's December 31st. So at 11:59 p.m. on December 31st, the company had $49,000 of capital. So how much capital did they have 1 minute later when it's 2016? They had the same amount of capital. So in other words, this $49,000 is the capital at the beginning of the year. In other words, January 1st. Okay. Then it says we're going to add our investments, also known as owner contributions. So we're going to look for either investments or owner contributions. They mean the same thing. And I see an owner contribution for 2016 of $25,000. Owner contribution. So that means the owner simply put $25,000 of extra cash into the business so that the business can use that to operate. What's next on our cheat sheet? After investments, we're going to add net income. Now follow the arrow backwards. Where did we get net income from? From the income statement. So we need to go back to our income statement, find out what the net income is, and plug it in. So here's our net income. And the number was $97,800. Again, you do not have to copy and paste like I'm doing, and you do not have to put in these commas if you do not want to. So that is a net income for the year, because that's what this says, net income, not a net loss. All right. Now notice over here, they've got a cell, but they don't have any label. So that means they want a total. So you also know they want a total because see this line right here? That means we're going to take these numbers and do some type of mathematical operation. In this case, are we adding or subtracting investments? Notice our cheat sheet says plus investments plus net income. So we're going to add those three numbers. So we've got 49,000 plus 25,000 plus 97,800. So 49,000 plus 25,000 plus 97,800 equals a subtotal of 171,800. Now, if you want to make it easier to read, you could put a comma in there. Just be careful and don't accidentally put in a decimal. I'm going to take the comma out because sometimes I screw those up. All right, so what's the last thing on our formula? Beginning capital plus investments plus net income minus draws, also known as withdrawals. So over here in our box, we're going to look for draws or withdrawals. Do you see any? Here we go. Wilson must be the name of the owner. Wilson withdrew 32,000. Copy, paste, and now remember, this says minus draws. So do we have to put a minus in there? According to our rules, use a minus sign or parentheses to show a decrease in capital. So yes, my accounting lab is expecting you to put a minus sign in there. And we're going to call these draws or withdrawals, owner withdrawal. So now all I have to do is take the subtotal, 171,800, subtract 32,000, we get the capital for the end of the year. So 171,800, oops, I already screwed up. 171,800 minus 32,000 gives us $139,800. And this time, just to make it easy to read, I will put the comma in there. So now let's analyze this. So what happened to the capital? So let's look at what this statement is telling us. The statement is showing us what happened to capital. Well, capital started off at 49,000 and ended at 139,800. So our equity, also known as capital, is going up. So is that good or is that bad? Equity is good. So what's the major reason why the company went, or the capital went up? The biggest reason it went up is because of net income. And that's a good sign. We have a profit. So then we check our answer. And now we're going to do our last financial statement, which is the balance sheet, which is just assets equals liabilities. And then the capital or equity account, and remember, capital is the same as equity. So you could say assets plus liabilities equals equity or owner's equity. But which equity or which capital? You have to take the ending capital, not the beginning capital. So first of all, let's do assets. Well, actually, before we do assets, let's do our three-line heading. So we have the name of the company, name of the financial statement, And then this is either a single day or a period of time. So think about this. Everyone's favorite asset, by the way, is cash. So if someone asked you how much cash do you have in your account, you would need to know, well, on what day? Do you mean today, or do you mean last February, or what? So the balance sheet is just a snapshot or a photograph. You can think of it as a photograph of the company's financial information on a single day. So what day, and here's my hint to you, what day are we using? The end of 2016. So the balance sheet is always a single day, December 31st, 2016. Now let's go back and find our assets. So I'm just going to go in order. Later on in subsequent chapters, we'll find out what the proper order is, but my accounting lab does not force you to do a certain order. So I'm going to blank this cash out. I'm just going to go in order that they have it here. So is land an asset? Yes, land has a future value. So we have $5,000 of land. Now my accounting lab does this weird thing where it's going to jump around. I don't like that. Students don't like that either. So notes payable, that's an expense, a liability. That's an expense. It's a draw. So let's see, what else do we have for assets? We got office supplies, $9,000. So I'm going to copy and paste that. Office supplies. Office supplies are things like the paper, copier, paper, printer cartridges, stuff like that. Let's see, what else do we got? Looking through here, we have accounts receivable. Now don't forget, this is an asset. So this $900 represents what our customers owe us. So that means in the future, they're going to pay us $900. So this definitely is an asset, it has a future value. And the company owns all of these things. So after AR, we've got a building. That's definitely an asset. $157,000 building. And after building, we've got cash, everyone's favorite asset, and also the asset that thieves try to steal. Equipment is next. That's definitely an asset. Equipment is like our computers, our printer. And I don't see any other assets. So let me close this so I can do some math. Now I'm going to add up my assets to give us total assets. I need my calculator. So I'm going to take 5,000 plus 9,000 plus 900 plus 157,000 plus 3,800 plus 19,000 gives us a total of $194,000, $194,700 of assets. That means when I'm done with the right side, this also has to be $194,700. Otherwise, I've done something wrong. So let's get back to our cheat sheet. So remember, the formula we're using is assets, which are on the left side in this case, equals liabilities plus ending capital. So let's do liabilities. So now remember, liabilities, for our purposes, are always going to have the word payable in it. So we need to find any payables. So let's start with land, no payables, notes payable. Oh, notes payable. So that's a liability, 37,000. Notes payable. Wish it wouldn't jump around so much. Do we have any other payables? We got a salaries payable, $900. That means as of December 31st of this year, at that point in time, the company owed their employees $900 of salaries, but hadn't yet paid them. Okay, so we now have $37,900. So let's look for other payables. Probably have accounts payable. There you go, accounts payable, $17,000. Copy, paste, accounts payable. Okay, so let me close this box. Now notice they've got this line here, this horizontal line. So that means we're doing some mathematical operation. So we have a whole bunch of liabilities, because remember, all liabilities for our purposes have the word payable in them. Don't try to put expenses here because expenses go on the income statement. So now we need to total up these to get total liabilities. So I can probably do this in my head. That looks like about $54,900. Okay, now for the moment of truth. Well, almost to the moment of truth. Going back to our cheat sheet, we need to use ending capital. That means the capital from the end of the year. So here's what some students do accidentally. Some students will mistakenly, now remember, do not do this. Some students want to use this capital. But is this capital at the end of the year? Well, look over here. What year are we doing? We're doing 2016, the end of 2016. This is a capital at the end of 2015. So this was the beginning capital we used. So we cannot use that. So going back to our cheat sheet, notice our cheat sheet says this ending capital, follow the arrow backwards, comes from our statement of owners, comes from our statement of owner's equity. So let's go back up to our statement of owner's equity. Oh, it's right here. We got capital on December 31st, so that's the same date as this. So we got $139,800 of ending capital. And we're going to label that capital December 31st, 2016. So that label matches this label up here. Now notice, let me go back to the capital amount that some students incorrectly use. If we had used this $49,000 and put it here, it would turn out that the balance sheet would not balance. And I'll show you. So let's look to see what our new liabilities plus ending capital is. So we're going to take total liabilities, $54,900, plus ending capital, and put the total here and hope and pray that it's the same as this, $194,700. Because remember, the balance sheet must balance, which means assets have to equal liabilities plus equity. So we'll get out our handy dandy calculator. So we've got 54,900 liabilities plus 139,800, and we better hope and pray that it's 194,700. And it is. So click here, shoot the amount over there, and that's called total liabilities and owner's equity. So all I've done is added liabilities plus owner's equity, also called capital. So now our balance sheet is complete. We've proven that assets equals liabilities plus ending capital. So what does this mean? It means the company owns $194,700 of assets. How much does the owner own of that? The owner owns $139,800 of it, and the rest is owned by others because we have this debt. Okay, now again, if we had used this incorrect capital over here, if we just simply plug that in here, then this balance sheet would not have balanced, and that would have been a red flag or a warning to us that we've done something wrong. And that's it. Don't forget to do the other part of the problem with the random numbers.